Good afternoon, everyone. My name is Allie Johnson, and I'll be moderating today's webinar. I'll begin by introducing the Capital Pathways program, introduce myself, and then pass the mic to our wonderful guest speaker, Justin Lewis. He's a Community and Economic Development Operations and Program Manager with People Inc. He'll introduce himself and take us through a presentation on credit building for small businesses. As we go along, please feel free to ask questions using the Q&A function. We'll respond to them at the end of our session. For any questions that we don't get to during today's webinar, we're happy to address them through our no-cost one-on-one services or connect you to resources that can help. We'll share a recording of this webinar as part of our follow-up email. So what is the Capital Pathways program? It is a program funded by the U.S. Treasury SSBCI initiative, sponsored by the Virginia Department of Small Business and Supplier Diversity, and hosted by the Virginia SBDC and George Mason University. We'll start with the program overview, then go through program eligibility, and finish up with an outline of the services we offer. Capital Pathways is a no-cost, specialized SBDC program that helps small businesses build the systems and habits needed to become capital ready. This matters because businesses that are less prepared can often self-select out or fail their loan applications. And these early failures correlate to a lack of adequate capital, and higher cost alternatives often don't build long-term capacity. Ultimately, only half of the loan amounts requested reach small businesses. So to put things in perspective, about 25% of small businesses need access to financing for growth and preserving cash flow. However, only about 20 to 30% of those who apply actually get their loans approved. To help address this challenge, Capital Pathways has created a path to financial and legal readiness. Our program offers an immersive, hands-on group experience paired with one-on-one support. Those who are eligible for our program include very small businesses and nonprofits at any stage who face challenges accessing traditional financing. The services we provide include a guided self-assessment, legal structure validation, financial skills and tools, loan application readiness, and credit building advising. We start our process with a self-assessment that pinpoints your business's key gaps so we can connect you with tailored resources, either through the Capital Pathways program or other resources that can help. Under our legal structure validation, our in-house advisors can help you through basic legal questions, and we also partner with a law firm that can help with more complex questions on topics related to business registration, trademarks, as well as contracts and agreement reviews. We also offer financial webinars on topics including financial basics, financial statement preparation, and QuickBooks training. In addition to the webinars, our one-on-one tailored support covers business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statements and tools, and loan readiness and lender preparation. These loan application readiness services include both webinars and one-on-one individualized support. Our webinars cover topics such as what lenders look for in loan applications, interactive mock loan interviews, SBA loan options, and sample application analyses. We also have a partnership with a lender who provides one-on-one support for those looking for capital. Finally, our credit building advising helps you review and interpret your credit reports as part of building an individualized credit improvement plan in order to strengthen your credit and help you qualify for better financing options and terms. If you're interested in getting started with us, you can reach out through our website at virginiasbdc.org/programs/capital-pathways. Or you can reach out to me directly at ajohn216@gmu.edu. I'll share my email and our website link in the chat for you all to have. Now, on to introductions. As I mentioned before, my name is Allie Johnson. I'm today's moderator, and I serve as the Program and Intake Coordinator for the Capital Pathways program. I have a professional background in economic development, small business support, and access to finance projects, both domestically and internationally. Our session today will consist of a 90-minute presentation. And again, please feel free to ask questions throughout the presentation using the Q&A function. We'll respond to them at the end of our session, and any questions that we don't get to today, we're happy to address through our no-cost one-on-one services or connect you with resources that can help. As I mentioned before, we will share a recording of this webinar in a follow-up email. I'd like to now pass things over to our wonderful presenter, Justin, to introduce himself, tell us a bit about his background, and start the presentation.
Thank you. Good morning, good afternoon, just barely, everybody. Thank you for having me. My name is Justin Lewis. I am the Operations and Program Manager of Community Economic Development at a CDFI called PIFS, People Inc. Financial Services, that is headquartered in Southwest Virginia. Let me get set up here, and then I'll launch into things. Make sure I have the chat open to see if anybody has any input or questions throughout the program. Okay, so what we're going to do today is this is a training I call Credit That Works. So we'll explore what credit is, how it works, how to build and maintain it wisely, and importantly, how personal and business credit intersect and then diverge. There's a really highly requested training that we get because in the small business space, especially at the micro enterprise level, you're working for yourself, it's one or two people in the firm. That is a really common point that we all have to navigate as both business support specialists as well as small business owners. So that's the focus of today's training. These materials were developed by PIFS as part of our ongoing community economic development efforts. I am a certified credit counselor with the National Association of Certified Credit Counselors, often helping people navigate from personal into business finances. And these are designed to be practical, relevant, easy to apply, the way you would interact with the system, because that's the way we work with people every day when they walk through our doors across our service area. So I encourage everybody on this call to ask questions at any time by putting them in the chat. I can't see you out there. I will kind of be doing my thing up here, but I'll try to keep track of those. And then some of those I may push to the end where we'll have a dedicated Q&A session. So if you have anything that you need explained in a different way, you might want a different perspective on, just mention it and I'll try to make that as clear as I can. So great. We'll get going. So as I said, we are what's called a CDFI. So that's a Community Development Financial Institution, which is a network of institutions across the country that all operate independently according to their own policies and their own missions. Our particular mission is to increase access to entrepreneurship. So that is through two arms. That is, on one side, it is access to capital for people to start and grow their businesses. And then also financial education and technical assistance like this training that we're doing right now in order for people to develop those skills that they're going to need in order to make sure that their business can not just start but thrive. CDFIs are independent. Many of them are nonprofits, but also some financial institutions as well. They each have missions tailored to their communities, so no two are alike. We have some outcomes from our most previous fiscal year that we're very proud of. The one I like to direct people to is this business capital that we deployed in our service area in Virginia. We deployed nearly $2 million just in the last fiscal year to folks in the form of small business capital. That is capital they would not have access to through the traditional lanes. So those are opportunities that we were able to help provide for folks who wouldn't have them otherwise. We also have a couple of other lending programs, but also our technical assistance. That number is over 17,000 hours last year, as well as a number of jobs created and businesses served across the region. Our service area is a little unique. It is 40 counties across the state, 24 of them are down here in the Southwest. I'm down here in Washington County, but we serve all 24 down here out to, Kentucky's out here, West Virginia's up here. And then we have another 16 counties up in Northern Virginia, in the Shenandoah Valley and the Central Piedmont, another 16 counties up there. So if you're outside of that region, welcome. I'm glad to have you on the training. This is where we are certified to lend money. We're happy to train anybody anywhere who's looking to learn. So if you are in this training and you're saying, okay, well, are there other CDFIs in my region? Yes, there are. Likely, no guarantee, but there likely are. And if you need help finding those, we're happy to point you in the right direction where we can. And there are also the folks at SBDC and through Capital Pathways are also really well capable of doing that as well. So let's jump into the training. Big disclaimer, beginning of all of our trainings, the big thing is this is for educational purposes. I am not a financial or legal advisor. I don't seek to be. I'm not licensed to be. So any choice you make about your financial situation when you walk out of this training, it's entirely up to you. Also, everything I say in this training today and the perspective and point of view of this training are from me. They represent my point of view. They do not represent the entire agency that I represent. And then obviously all of this is subject to change. It could change tomorrow. It could change later this afternoon. It does. It changes very rapidly. So the objectives of this training, Credit That Works. I'm going to start by establishing personal credit scoring and reporting so that we have a good baseline. We understand how that works because we all interact with that system. And that's where the whole process starts. So that then we can look at how business credit scoring and reporting is similar and different and where they intersect. We'll look at how they intersect, and then we will look at a sample of business credit products. I don't endorse any particular product. I'm not here to sell anything. We do lend capital, but that is through our unique programs. I do not endorse any particular product. Those choices are ultimately yours, but the categories of products. And then finally, what you'll need to prepare when it's time for you, may not be tomorrow, might be 2 years from now, 5 years from now, what you need to prepare when you go to try to seek borrowed capital. So why is credit important? We all know that it is, but why is it? So on the personal side, the way we interact with it day to day is we might need to do things like pay for college, buy a home, other major purchases like equipment, automobiles, recreational items like, boats and ATVs and things. You might want to start or grow your business, which is probably why a lot of you are on this call today. It affects things besides borrowing, like your insurance rates, the amount, and whether you're required to pay a security deposit on a rental. So your credit, as it's scored and reported and reviewed, has influence on many different aspects. These all fall into one basic category, and it's wealth building. It is a tool for wealth building. Credit is not wealth itself, but it is a tool in the process to building wealth if used properly. But on the business side, you might use it to invest in your business, to grow your business. At a certain point, there will be a time to invest in your business. Where that money comes from can be a wide variety of options, but oftentimes small business owners are skittish to invest in their business. But if done patiently and strategically, there will be a right time to invest where that equilibrium starts to say, okay, once I invest, I'll actually start to increase capacity, increase profitability. It also, credit, helps you weather the ups and downs, the seasonality of your business. You might, your expenses go out every 30 days, like they do for most of us on the household level too, but your invoicing might come in more at 60 to 90 days. So how do you bridge the gap between your accounts payable and your accounts receivable? And then you might want to win bids, government contracts, attract investors. There might be a new phase of your business, and credit can be a tool to help you get there. So how do they intersect? Business credit starts at your personal credit. What I mean by that is that business credit does not materialize out of thin air. If your business doesn't exist, if it doesn't have established credit history, they're not just going to make up a number. they need demonstrated credit performance. So what they're going to assess first when you go to apply for credit in your business's name, they will assess your personal credit performance in order to assess the risk of that. So, and that's across sectors. That's whether you're in alternative mission-driven lending, like my sector, or if you're in traditional lending with a bank. They will look at your personal credit performance. They will likely require a personal guarantee. We'll talk a little bit more about that later. But one way that you can start investing in your business right now, even if you're not out seeking borrowed capital, is working on your personal credit, getting derogatory marks cleaned up, improving your utilization and your availability, because it will set you up for the time in the future when you are ready to go out and seek that capital. Also, your consumer reports are details of your credit history, whereas your commercial reports are summaries. We'll talk about the difference between those. Everybody has a credit story, the story that of how and why your credit looks the way it does. The data matters, the facts and the figures matter, absolutely. But if you have a coherent narrative for why things look the way they do, that will support your proposal. So a good example is separation and divorce. It's a really common reason for checkered credit histories. Your accounts were all tangled up years ago, even 3-4 years ago. In the process of getting them untangled, accounts got lost. You didn't have access to them. Your ex had that, that telecom account or whatever, and you didn't, and it's still on your history. If that kind of coherent narrative is able to justify, here was a rough patch, I was injured, I had a medical incident, something like that, that all contributes to the credit story. So yes, data matters, facts and figures matter, but the credit story underlying that matters a lot as well. So let's take a little glimpse at personal credit reporting. Let's get our heads around that. So your credit report is the details of your credit history as it's reported by the lenders. That's a really important facet, is as it's reported by the lenders. There is no universal credit report. There is no absolute objective truth. There is as it was reported by the lender. And so it tells us the type of credit that it is. So is it fixed? Is it revolving? Is it a student loan? Is it a mortgage? It tells us how long it's been opened to the month, and then whether those bills have been paid, going back 24 months. It shows us 24 months of payment performance, whether they were on time and how many billing cycles late, if they were late. The personal information that is attached to your report starts with your personal identification information, so your addresses that you've been associated with, your social security number, your date of birth, your account history, including the creditor, like the name of the bank, the payment history, like I said, going back 24 months, the current balance, oftentimes and frequently the monthly payment that's due. So if it's a revolving line of credit, like a credit card or a line of credit, it might show us what the credit limit is. So the account information has all those details. We know what kind of credit it is and where it stands when they've pulled the report. Your public records, and what this means is public records are things like your judgments, like you've been sued for the debt and you owe it according to the law, your bankruptcies, your child support, your alimony, things like that. On your consumer report, your personal report, the only public record that shows up are bankruptcies. So that's been since 2018. So things like your tax liens and any judgments that have been filed against you, those no longer show up on your consumer report, only bankruptcies. And then inquiries is the last piece. Inquiries, there are two kinds. There's a hard inquiry and there's a soft inquiry. A hard inquiry is when you applied for credit. You signed the form, you went online, you said, yes, I authorize, I am applying for credit. If you gave it to me right now, I would have it, basically. That's called a hard inquiry. A soft inquiry is for information purposes. It's when a creditor that maybe you already have does a soft pull on your credit just to review the information. It is not an application for credit. This is also the case when you go in and pull your own consumer disclosure reports. Those are soft inquiries. They're not official applications. Inquiries appear for 12 months on the report. The hard inquiries get factored into the score because you were going out, you were seeking capital. The soft inquiries do not. They'll show up there. They'll be on there much more frequently. We'll look at an example of that, but they don't affect the score at all. After 2 years, inquiries are removed entirely. So obtaining a consumer report, a personal report for yourself, you might want to do that because you're applying for jobs, your career change, you're moving somewhere, you're relocating, you're trying to make a major purchase like a home, like a vehicle. You're going through something like a divorce or separation. You want to see how things are showing up on there. How are they reported? Which of these are linked? Which of them have aged off and which of them are current? You might be trying to prevent or fix some identity theft. Maybe there's some credit fraud going on with your information. You may want to set goals. You want to invest in your business. You have a timeline for your business. Okay, I think I'm going to be ready to try to get a loan in order to lease the space that I'm going to move into in 2 years. Okay, well, 2 years is a long time when it comes to credit reporting. So what can you do now to influence your flexibility then? What will give me the most opportunity at that point? So that can be a good enough reason to go in and review your information. These all fall into one category. And that category is someone else will be looking at it. So you always want to review it before somebody else is going to review it. But you don't ever want to be caught by surprise by something that shows up on your credit report. You are entitled to go in and review these things for yourself. You're entitled by law. We'll talk about that. So take advantage of that. Make sure that you're not finding out about a derogatory account, a delinquency from somebody that you've applied with. You're down, you're trying to get a good auto loan, and they say, "Hey, did you know you had this collection on here?" That's not when you want to find that out. You want to find that out for yourself. So, as I said, you are entitled to one totally free, absolutely no consequence report once every 12 months. That is required by law, by federal legislation. So once a year, you can go on to each of the 3 credit bureaus and pull a report from each of them for review purposes. There won't be a score attached to it. We're talking about reports right now. So it's just the data. It's your name, it's the accounts, it's how they're showing, it's how the credit performance is showing. The official place you go to get that is annualcreditreport.com. This is the official site. Write this down, annualcreditreport.com. It is not free credit now. It's not get credit here or else. It's not that. It is annualcreditreport.com. That is the government sanctioned site for you to go on and pull these reports. As I said, there are 3 bureaus, and you've maybe heard of a few of these, if not all of them. It's Experian, it's TransUnion, and it's Equifax. If you have a credit card or something like that, you've probably heard these names float around. These are each independent for-profit companies. They do not have any obligation to talk to each other, share data across each other. So each of the 3 will have different data. They will report it differently. And so your reports are going to vary according to who the bureau is. So you're going to want to go on when you review your report and pull one from each of the 3 because they will show differently. You might have a credit product that shows on this one, but not on that one. Why is this? It's because each of them have different subscribers. So that means they have different info. Also, not all creditors report exactly the same. So many creditors don't report their on-time consistent payments. They only report delinquencies. There are some things that only show up at all if they become delinquencies. Things like small medical bills or your rent or delinquent utilities. Those only show up if they become delinquent. It's important when you go on here and review them that you review all of the information and make sure it's accurate to the letter. And I mean, is every digit of your social security number accurate? Are all of the addresses you're associated with actually yours? Are all the trade lines accurate? If they are not accurate, if there's incorrect information on there, which that happens, there's hundreds of millions of people in the United States. We all have credit reports. It's important to identify those and resolve them. You do that through what's called a dispute process. So you dispute it with that bureau. You say, Experian, my middle initial is wrong. And you dispute that and you say, that's not accurate. Because there's probably, I'm Justin T. Lewis, and there might be a Justin D. Lewis or a Justin T. Lewis Jr. that has gotten tangled up with mine, or it's just entered incorrectly. You want to dispute those and resolve them as you identify them because it can create big, big problems down the road. You will need to dispute it with each bureau independently. So if it's something that's showing up incorrectly on all three, you need to go in and fix it on all three. Nowadays, you can do it online, that dispute process. So it's much simpler, but you will want to do it with each of them separately. Now, the ideal candidate, and this is ideal, so everybody, there's a range of outcomes when it comes to candidacy. But they're going to have 3 to 4 revolving accounts. So that's things like credit cards and lines of credit with really high credit limits and really low balances. This is called your credit utilization. So how much of your available credit are you using? That's what that term means. So ideally, that number never goes over 30% of your total, what's called your global credit availability. Let's say you have 3 credit cards that all add up to $10,000. That would mean that at the most, at any given time, you are only using $3,000 of that at any given time. So they want to see you have credit that you're not using. That's a good sign to the lenders, the credit analysts. They want to see you have a strict card, like a travel and entertainment card, one that's quick to revoke privileges. Harder cards to get, harder cards to keep. So these are typically, rewards cards of some kind, not just your rank and file, get it in the mail card, but a really high quality card. They want to see those trade lines be as old as possible. So at least more than 6 months. That's about how long a trade line takes to show up on your credit report and start influencing the calculation of the score at all. But ideally more than 3 years. So best practice here is don't close out lines of credit, even if you're not using it. You can take it down to 0 and then keep it open but unused. If you have to use it periodically, use it just enough to keep it awake, but then pay it off. Don't carry any interest on it at all, and then just keep it open because it shows a lot of availability. No derogatory items of any kind, so no late payments, no collections. Few inquiries. Everybody needs credit sometimes. So a couple times a year is totally fine. But what they don't want to see is that you're going out every month and applying, your credit card this month and then a loan down at the Bass Pro that month. And they don't want to see you shopping credit all the time. And then at least one installment trade line. So a non-revolving account, something that you've gotten a loan and you've made steady payments over time. They want to see you make those steady payments. So the A+ version of this is your mortgage. You pay your mortgage for 30 years. You make that payment on time every time. That's a really good affirmative mark on your credit report. So then they take this data in your credit report and they score it. That's how we get the kind of infamous credit score. So that data comes from the report, and then it gets put into a model that tells us the calculated risk of loaning you money expressed as a numerical value. So they're trying to say, how likely are you to repay expressed as a number? In personal credit scoring, that number ranges from a low of 300-ish to a high of 850, so 300 to 850. The industry standard company on this is called FICO, or Fair Isaacs Company. They've been around since the 1950s. They became an industry standard kind of around the 1990s. They do have a competitor that's much younger, called Vantage Score. They were established in 2006. They are rising in popularity. You might see that if you look at one of your little kind of features on your credit card app. It might say your Vantage Score 4 or whatever. They use a slightly different calculation method, but the underlying principles are the same. So what's good for one is going to be good for the other. Um, it is important to remember about your credit score that there is no one credit score. So a credit score is a snapshot in time. It is this moment. It is when it was pulled. And then also, it is what it is for. So there is not one credit score. There are a range of them that are all calculated differently based off of that particular model. So you go down to this auto loan place, and that lender likes the Experian Auto 4. They feel like that fits their risk model really well. So they subscribe to the Experian Auto 4. But you go and apply for a mortgage down at Mortgage Broker HQ, and they like the TransUnion Mortgage 8. That's going to be weighted and calculated differently than the auto because it's a different product. It's on a different term. It's much longer. It's for a different item. So depending on which scoring model that lender subscribes to is what that score is going to be for. So there is no universal. And they could range very widely. This one could be a 700 and the next one could be a 680. And that might be the difference between whether that financial institution is willing to work with it or not. We're going to use FICO as an example. Like I said, the underlying principles are the same, but what goes into the score? How do they get to that number? Number one, the biggest factor, payment history. 35% of the score. Do you pay on time? Do you pay as agreed? More recent actions factor more heavily. So a missed payment last month matters more than a missed payment 2 years ago. Next behind that, still very important, 30% of the score, how much you owe, your balances. Specifically, your balances relative to the credit limit. So I talked about utilization earlier. Are you walking around with maxed out credit cards? Or is that utilization you walk around with balances under 30%? And then also just how much are you leveraged? Do you have the mortgage as well as the $80,000 truck that you're paying for, as well as a load of student loans, as well as this equipment loan, as well as that. So on and on and on, amounts owed. How long they've been open, still very important. This is the length of your credit history. Like I said, it needs to be at least 6 months old to even affect the score. So the older, the better. They want to see you manage credit for a long period of time. The smallest factors, one is the credit mix is only 10% of the score. But have you used revolving as well as installment and a mortgage and an auto loan? Have you used a variety of credit and showed that you can manage that? Good rule of thumb here is don't take out unnecessary debt just to improve your mix. It's a pretty small factor all told, but as you're going along, letting that mix organically evolve, so the big thing is you don't want all of one kind, all credit cards or all, I mean, installment loans aren't bad, but you want a good mix of those things. And then finally, also the tied for the smallest amount of the score is new credit. This is primarily only a negative factor, meaning how much new credit do you have? Because they don't know how you're going to perform on that. So you went out last month and you got 3 new loans. Well, have you made steady payment on those? We have no way to know. It makes you look what's called credit hungry. You're going out, you're shopping credit all over the place. Besides what I mentioned about not having performance history, that can be a red flag about, well, why is this person doing that? Are they having income struggles? Do they have stable income, stable employment, stable housing? It can be a risk factor. There are things that do not and are not permitted to go into your FICO score. Demographic information, like your race, your color, your religion. Your age is not a factor. Your salary, your title, your employer, those aren't in your FICO score. Now, that doesn't mean that the lender won't want to know those things. They absolutely will. The first question at the top of an application for capital on the personal or business side is, how much money do you make a year? So the underwriter will want to know, for the loan, but it's not in your FICO score. Where you live, it's not different for me here in Southwest Virginia as it would be for somebody up in Northern Virginia. The interest rates on the accounts that you already have, your rent. Your rent does not factor into the score unless you're part of a rental reporting system, which are kind of newer. They're still very nascent. They're not very common, but they are out there. Your child support, your family support, your alimony, those are not on your credit report unless they become delinquent. So if you're behind on it, that'll show up as you're behind on your child support. And a lot of times, this is true for our policies because of our funders. That is an instant disqualifier. Outstanding child support we're not even permitted to entertain that. Your non-credit banking information. So your deposit accounts, like your checking accounts, your savings accounts, those things aren't on there again unless they become delinquent. If they become a collection, then it can show up. And then those consumer disclosures, those promotional inquiries, those soft inquiries we talked about, those are in the score. So the big question is, what is a good credit score? The answer to that is a big it depends. Depends on the financial institution, what their appetite is. It depends on what you're applying for, the type of loan, how much you're applying for. So all of that factors in. So you can't say what is a good one. Obviously, the higher the better. If you can get up over 700, you're starting to look at green fields, blue skies. Go run after it. But it's going to vary a lot. So, but obviously, the higher you can get it, the better. Now, delinquency and credit rehabilitation, getting behind. How do you build towards the future? How do you rehabilitate derogatory marks? The good thing about it is that credit reporting and credit scores are all data. There is no emotion involved at all. So what that means is data in, data out. So that means better data in, better data out. So positive actions equal improved score every time, 100 times out of 100. It's not like the comparison I like to make is it's not like diet and exercise where you're kind of like, is this working? If you take positive steps, it will improve. But what that means, the trade is you must have active trade lines in order to build. So just resolving derogatory accounts won't build your credit. You must replace it with positive affirmative credit actions. So the cycle of that starts with your active healthy accounts, they're current, they're on-time accounts. It's also any account that's been paid off within the last 10 years. So that auto loan you paid off 6 years ago, still sitting there as a good positive mark on your credit history. The next phase is it's late, but it's active. So that means it's behind and it can be made current. So you're a month behind, one billing cycle behind on your credit card payment. If you pay that and then also pay the current one, hey, you're on time. It moves back up into the green category. That becomes an active, in good standing account again. It is important to revive these before they become what's called charged off. Now, charged off means that the creditor said, we're not going to be able to collect this. We're taking this off our books. We are calling this a loss. Once they've charged it off, they might send it to their collections department. They might sell it to a third-party collector. They might sue you for it. The reason you want to catch them before they get here is that they can never be made active again. It can never be uncharged off. So once it gets into this category, it can never be an asset again. It can never help you build that active trade line. So if you can catch it and it's late, but still, not charged off status and return it to active, you want to do that. As it ages, if it's been charged off, as it ages, it will factor less and less. But at that point, that's all you can do with it is just let it age and replace it with good, positive habits in between now and then. Because like I said, the older it is, the less it matters. So that means there's a timeline to factor in here when it comes to personal credit scoring. There's an important date called your date of first delinquency, and that is by law when the account became 30 days late. So you missed a payment on the first of the next month. That's when it became delinquent. The date of first delinquency. That date never changes. It is locked. So September of 2022, date of first delinquency, it locked in that date, and that only changes if you bring it current again. And then, if you have a different delinquency, that's a different delinquency. From that time, from that date, it appears on your report for 7 years. So it'll appear there as that delinquency for 7 years. This is different from what's called the statute of limitations. The statute of limitations is how long the creditor has to sue you for the debt. The statute of limitations is legislated by the state. So in Virginia, it varies from 3 to 6 years, depending on what kind of credit product it is. Now, the statute of limitations can reset. So I said that the date of first delinquency locks in, can never change. Even if you make a payment on it, if you acknowledge the debt, it's still locked. The statute of limitations, however, if you say you do a workout or you start a payment plan, that resets the statute of limitations. They have a new 3 to 6 years to sue you for it, basically. The one exception to this timeline is bankruptcy. Bankruptcy shows up on your credit report for 10 years, and it's the only item like that, but it's unique to itself. One tool you can use in personal credit reporting, if both to kind of prevent identity theft, but also for any behavioral influences you want to have. You say, like, I don't want to take out any credit for the next year. Credit alerts and freezes. A credit alert is where you set that on with the bureau. So like with Experian, you say, I'm going to put a credit alert on this. And that means that anytime somebody applies for credit, they contact you and they say, hey, is this you? And you say, yes, it is. Or you say, no, it doesn't. And then depending on your answer, they go forward with it. If it's a freeze, no one can apply for credit, including you. So if you needed to go try to get a loan for a car or something, you would have to lift that freeze, go make your application, and then close the freeze back down. You have to do alerts and freezes with each bureau individually. There's not one that applies to all of them. Now, this is all legislated by a couple of very important federal laws. The Equal Credit Opportunity Act. This is the one that says that anytime you apply for credit, the lender must tell you within 30 days whether you've been accepted, rejected, or ruled incomplete. They also have to tell you which credit bureau they used, and they have to tell you why it was ruled that way. And also the Fair Credit Reporting Act is what sets the rules for how your credit's reported, on what routine, in what manner. So there are a couple of very important pieces of legislation. So when we get in here and we look at business credit, your personal credit is attached to your Social Security number. So your identifier, your personal one. So that's why it follows you through your whole life. Your business's credit is going to be attached to your EIN, your employer identification number. Now, most business loans will require a personal guarantee. And what that is a legal promise for you to repay the business's credit accounts if the business can't make those payments. So, you've got your coffee shop, you're the personal guarantor on that loan. If the coffee shop folds, you're still on the hook for that debt. Now, personal guarantees for many credit products are required. For SBA loans, for instance, anybody with 20% or more stake in the company is required by law to provide a personal guarantee. We ask for a personal guarantee on our loans. Now, the guarantor doesn't always have to be the owner. You can have co-signers and third-party guarantors sometimes, but oftentimes they will need some kind of personal guarantee. Now, business loans, depending on how it's categorized by the lender, may or may not appear on your credit report or your personal credit report. So I've worked with clients that they have a commercial loan with their business. And because of the way the business codes that particular loan as a commercial loan, it doesn't show up on their personal credit report at all, even though they have a personal guarantee. So that can vary a lot depending on how the bank treats that particular product. So the big difference is when we're talking about business credit reporting. So the biggest thing to remember is that there are just way fewer regulatory standards. I have on here no regulatory standards. That might be an overstatement, but many, many fewer. For instance, There are no free reports of any kind. This is a pay-to-play service. This is a paid service. You pay to take part in it, or you don't pay and you don't take part in it. Also, things like the delinquency timelines are entirely up to the lender. So they might say a delinquency is 1 day late, or they may say it's 30 days, or they may say it's 5 days. It depends on how they want to report it. Whereas, if you recall, with personal credit reporting, delinquency is required by law to be 30 days. It can vary in business credit reporting. Now, these scores and these models are proprietary. They're selling a service in this case. So the underlying principle still applies. Pay on time, pay as agreed. If you're doing that and you have business credit established, you're building positive credit history. That's reliable, as long as you have it established. And we'll talk about some ways to do that. So on your commercial report, the major players in this category are, sorry, I pulled up the Q&A so I could start taking a look at this. Thanks for putting all these questions in here, everybody. The major players in this category are Dun & Bradstreet. That's the one folks know because you used to have a Dun & Bradstreet identification number in order to do government contracting. We'll talk about that in just a minute. But that's the one people know. They have their Paydex score. That's very common. But Equifax and Experian also have commercial credit reports and scores. TransUnion chooses not to. They are consumer reports only. Now, commercial credit reports range from 0 to 100, so a different scale. So the higher to 100, the better the score. These are pay services, and the cost may be prohibitive to your business, especially if you're very fee conscious, if you're very your cost structure still is in its growing phase, its growth phase. So for a small business, again, especially micro enterprise, you may want to pick and choose your investment based on a timeline. So instead of subscribing all the time forever, you may say, okay, I'm going to want to try to get a commercial space. So I will subscribe for this period of time and check in on it. How are things showing? Does that one vendor report? Where am I standing on that? And then not subscribe to it at other times. Also, with a business credit report, anybody who's willing to pay the fee can have access to your report. They can go in and view it. So it's part of not the public record. That's an overstatement, but it is publicly accessible if they're willing to pay the fee. Now, I mean, logic bears that they would only pay that fee if there is a reason to justify that expense. So it's usually going to be a vendor or a creditor. But there are regulations on that on the consumer side. Like we can only access your consumer report under very specific conditions. In business credit reporting, as long as somebody's willing to pay that fee, they can have access to it. And then for your Dun & Bradstreet score, that you get what's called a DUNS number. I think it's Data Universal Number System. You used to need that in order to bid for government contracts. That's no longer the case. Now the federal government contracting program has their own unique entity identifier, so their UEI number. So you no longer need a DUNS number. So back in the day, everybody needed one. You can have a DUNS number is free, but the services that Dun & Bradstreet provide are pay. So that's entirely up to you if and when it's right for you. It's also important to remember that these are summaries. They're not specifics. So the information that's on it, your business's identification information. So like I said, that EIN number, how you're registered with the state, things like that. Your Justin Lewis LLC. Your business's credit history, but in summary form. So whereas before it was the creditor and the balance and all that stuff, this one is categories. So your line of credit at the Office Depot for your business is going to show up as office supply store. Payment history is still the key component here, but they use a term in business credit reporting called slow pay. Now, slow pay could mean a lot of things. It might mean you're past due. It might mean you're delinquent. It might mean you're a habitual slow pay. And also, they might show the balances, the amounts, the due dates may vary, and they get to set those based off what that creditor who lent you money, they get to determine when you meet that threshold. So they may base it off of when you've gotten a certain amount of credit access. When people get to $100,000, then we start reporting. Or when people have this many contracts, this is when we start reporting. That's entirely up to the creditor when it comes to commercial reporting. It's not mandated. It's going to show your legal and your public records. Now, in personal, it's only your bankruptcies, but on the business side, it is your bankruptcies, yes, but also your UCC filings on your business. So when have you borrowed money and they've filed a lien on your business assets? It's also going to be any liens or judgments or collections against your business. It's going to show the whole gamut of public records. It's going to show your credit inquiries, and this is the number of times a creditor or an interested party has viewed that credit report. Because like I said, anybody has access to it if they're willing to pay. You still have hard and soft inquiries. So the hard ones apply or when you're applying for credit, and soft are for account monitoring. How long these stay on vary, again, in the commercial space. The big thing here, too many inquiries is going to be a red flag. Again, it's going to look like your business is credit hungry in this case. What's not going to be on your business credit report is your personal information. That's not on there. Your personal credit accounts, again, not on there. The financial statements of your business, your profit and loss, your balance sheet, your cash flow statement, those aren't on the credit report. Your business's banking information. Now, again, underwriters are still going to want to have that. They're going to want your business bank accounts or business bank statements. So keep that in mind. So business credit products fall into a few categories. The important thing to remember here, and when people say, how do I establish it? There are about 500,000 vendors, business to business vendors in the US market. About 10,000 of them report to a bureau. So that's a pretty small percentage. And the reason is that it carries a cost. It's cost prohibitive to them to report. So that's the biggest factor when you're trying to establish your credit is, are you with a vendor that reports at all? The categories are things like your business credit card, vendor credit, a business loan, and lines of credit. And we're going to look at these in ascending order of cost. So the cheapest form of business capital is your term loan. So you go to a bank, credit union, community lenders like us, things like SBA loans are term loans. This is, where you get a fixed amount of money and then you pay it off over a term. These are best for things like large purchases like acquiring property, your startup, your expansion expenses, a project that is capital intensive that won't be paid until the end of the contract. Things like that, where you have a large amount of money due at one time. The important thing to remember here strategically is match the term to the purpose. So you only want to pay the loan for the useful life of what you borrowed that money for. So with equipment, that's pretty easy. I've got this piece of equipment. It's going to last about 3 years. Paying that off over 3 years makes total sense. But if you get inventory that's only going to make you money for 3 months, you don't want to pay that off over 3 years. That's going to be a drag on your business. So match the term to the purpose. Next up in cost is a line of credit. So a line of credit has a draw period where you can draw down on that. You have a credit limit, just like a credit card, but you can draw it down in cash. You pull it into a bank account. So that means you can, use it to help bridge the gaps in payroll, and some vendors only take cash. And then at a certain period, it locks in to its repayment period. And from there, it becomes a term loan. So you have a draw period and a repayment period. This is a form of revolving credit. So if you're still in the draw period and you pay some off, you have access to that again, kind of like a credit card. With a line of credit, there is typically no grace period. So interest starts accumulating as soon as you do the drawdown. And these are best for businesses that usually have large volume inventory or supply heavy businesses where the perfect alignment of your accounts payable and accounts receivable is difficult to line up. So, you need merchandise on this day, but you're not going to get paid for it until this period. And a line of credit can help you bridge that gap when properly managed. Then you have vendor credit. So this is where with the supplier of the good or service, you are getting credit with them. There are two types of vendor credit. There's your invoicing credit. This is where you get the product or service, and then after the billing cycle, they invoice you for that. So a really common one is auto mechanics. So, they tell me the bill, they say this part's going to be $100. They build it into my bill. They order it from Napa Auto Parts, and then at the end of the month, Napa bills them for all of the equipment that they purchased. And the auto mechanic has set that money that I paid aside to pay up that invoice. So it costs them nothing. I paid that. You're going to be on a cycle like a net 15, which means you have 15 days to repay or 30 or 45. You want that to be as long as possible so that you have more time to pay that invoice off. And then you also have vendor financing. So this is you're financing directly through the vendor. So this is really common with big, heavy equipment. You go to the Kubota and you're getting that $55,000 excavator or something like that. You can finance directly with the vendor. Now, these are good. Vendor credit is good for establishing those long-term relationships. You have you're the auto mechanic, and you have a really good relationship with the Napa that's down the street that gets all your parts, and they know you're a reliable payer. If there's a hiccup, they'll help you navigate that. But the trade-off is they are much less likely to report because they're smaller, and so it's going to carry a cost to them to report. So you're likely not getting any contributions to your business credit through vendor credit, unless we're talking about a big national supplier. And then your credit cards. So the store card, a vendor card, corporate cards, just your standard business card that you get advertisements for. Now, credit cards are best for regular cyclical expenses. So ones that you basically know are coming. Really commonly, fleet cards are, so you have 5 trucks for your landscaping company. Instead of chasing down an invoice for every time one of your workers needs to put gas in the truck, you have a fleet card. You have the capital to pay that, but you're just not chasing down you're not chasing down every transaction individually. They're using the fleet card, it's getting pooled into that one account, and then you're paying that off at the billing cycle. PIP parking fees, memberships, registrations, you're the member of 5 chambers of commerce, something like that, where that membership fee is going to hit. Big thing here is don't carry a balance. This is very expensive capital, just like in your personal life too. But this can be a way for a lot of folks, again, especially on the micro enterprise level, to start to build their business credit. So in your business's name, sometimes to get your foot in the door, to get some kind of business credit activity demonstrated, this can be a way to get that started. It's not the only way, but it's a really common one. Now, any of these can be secured or unsecured with collateral. Keep in mind that business assets, your equipment, your inventory, are weak collateral. They are worth much more to the business than they are to a creditor, because once they've collected on those and auctioned off, how much have they really made? But they do look at something that you can call emotional equity. So what is this piece of collateral worth to you, where you would be less likely to want to see that go than the actual true monetary value of that thing. So even if there's no real world value, the borrower can still share in the investment of that. And keep in mind that you can't use credit for all of your expenses. Your tax liabilities, certain vendors only take wire transfer, they don't take credit. So keep that in mind, that you will also need cash. So where you go to look for varieties of business credit is your banks and your credit unions, your vendors and your suppliers. There may be nonprofit and community lenders like us, like CDFIs. And then licensed, reputable online lenders. Not all credit is created the same. So make sure the important thing to remember here is know what you're getting, know the terms. Sometimes they are packaged as one thing and they end up being something else on the other. I'm never here to tell you how to spend your money and never here to tell you that something might not be right on the right occasion. But you can only do that if you know what you're getting. So questions you want to ask yourself with your business. Is your business formalized? Is it registered? Is it structured? Registered with the state and with the federal government, your articles of organization or incorporation, you have those all in place. And then you have regular and clear business expenses. You know what your business costs, you know what your inflows and outflows are. And then notably, you have a plan to grow or expand. You know what the next phase is. Okay, with this money, I can take my business to this next level. And then of course, the capacity to make all of your current payments and then also make the new payment. When you go in, they're going to want your bank statements, both personal and business, your monthly income and expenses. Again, definitely on the business side, but likely also on the personal side because they're going to want to see global coverage when you're first getting started. Your business debt to income ratio. How much debt are you carrying based on how much cash flow you have? Your cash flow projections. How much do you, looking forward, usually 12 to 24 months, sometimes up to 5 years, I've seen. Your business and your personal tax returns. Your business's financial statements, your P&L, your balance sheet. Your business's registration paperwork. They're going to need proof that you're registered. Any organizational documents you have, partnership agreements, things like that. And then the business plan. And the business plan needs to state how you intend to use the capital. This is very important. So you're seeking $10,000 of capital. What's it for? Like to the dollar. Like this much is for equipment purchase, this much is for inventory, and then this much is for working capital for this amount of time. The signs that you may not be ready, your business is still an idea. It's not totally formulated. It's not totally formalized. Sometimes it's not that it's a bad idea or that it's not going to be a good idea, but it's not the right time. So you don't want to be servicing debt before your business is capable of servicing that debt. You don't have the cash flow to make a payment. You cannot borrow your way into revenue. So your underlying cost structure must work. You may need to improve your personal credit. It's not quite there where they're going to be able to give you business credit on top of your personal liabilities. You may need to work on that. Again, we talked about how to do some of that. You haven't formalized the structure yet. You haven't, maybe you operate, maybe you make some money, you report on your taxes, you pay your taxes, but you haven't registered with the state or you haven't gotten your license, something like that. You have disqualifying liabilities like your tax liabilities, a delinquent federal student loan, something like that, that you need to get worked out before you can go apply for credit anywhere. Now, keep in mind, we live in a modern world of convenience, of course, and there are a great many online web-based lending services. They're quick, they're convenient, they're accessible. The important thing to remember about this industry is it's very new, it's very young, and the laws haven't had time to catch up with it yet. So what you get in one place is not going to be apples to apples the same that you get from another place. Banking has been around for 200 years. The laws have had time to kind of catch up with the practices. And so keep that in mind that with the buy now, pay later apps, the point of sale lending, that that it's a highly unregulated industry and that the terms can sometimes be murky and that the fee disclosure is not always clear. There's a lot of fraud and identity theft in the industry right now. So I'm not here to tell you that it's good or bad, but just know to really do your due diligence to know what you're getting, because it's really easy to get locked into a credit product that's hard to get out of. And once you've committed to it, you're on the hook for it. It's not gonna disappear. So best practices is always have a plan to repay, not just the intention to repay, but a plan. How are you going to make that payment month to month until it's paid off? Always borrow for investment, not for revenue. No amount of borrowing can fix an upside down business operation. Have it before you need it. So if you're going to need to invest in your business this summer, be working with your banker, with your CDFI lender or somebody now, so to where you've primed the pump and you're ready to get it when you need it and you're ready to apply it and deploy it. The last thing you want to do is walk in there and they say, when do you need this capital? And you say yesterday, which is very common, but that's what you want to have it before you need it. And then keep your business and your personal finances separate. identifiable. Doesn't mean you don't live off some of that income, but don't pay for personal expenses out of the business account and vice versa. So what does PIFs do? People in Financial Services. I've said CDFI many times, but we are a nonprofit lender with a mission-driven focus. Our ultimate goal is community economic development. So we want to see job growth. We want to see economic activity. What that means on the lending side is that we can be more flexible. We take a holistic approach to our underwriting. Doesn't mean we're guaranteeing everybody capital. We say no to folks too, but it means there's no one particular criterion that is the disqualifier. We don't have a fixed credit score. We don't have a fixed equity injection. Those things are taken into account in a holistic sense across the whole package. It also means we work in partnership with everybody, with the traditional lenders, with the support agencies, with folks at Capital Pathways and the SBDC, is we are here as part of the larger ecosystem as a connector. And then we provide things like this, training and technical assistance. Where can we help upskill the community and help encourage entrepreneurship so that there's more activity for everybody? Here's a little snapshot of our credit products. That yellow banner there, that's the structure of our business loans. They all come in the shape of fixed term loans, all required to be secured. We work with a lot of startups, but not exclusively startups, also expansion. And then we also have access that we pay for to make available to folks like you to a learning management platform specifically for small business owners. There's a really common pain point of I want to learn more about my business and how to run it, but when am I going to find time to do that? How do I get to a lunch and learn? How do I get to a breakfast, something like that? But I still want to learn business management skills, marketing skills. Well, one of the solutions we're trying to provide is by providing this to anybody who requests access to it. So we make this at the premium level available to anybody who requests it. So I encourage anybody, if you have interest in participating in Initiate and having access to that, register through the link. Get in touch with me and I will send you an invite, and you are welcome to have access to that learning management platform. So now we're into questions. So we have a bit of time here at the end. I'll go back through the Q&A section here.
Yeah, and I can also help ask those questions so that you can focus on the responses.
Sure.
All right, so first,
Do you mind leaving the question up until I've finished the answer and then take it down?
absolutely.
Thank you.
Cool. So our first question is, do you work with nonprofit startups?
At PIFs, we do. Yeah, we don't have the restrictions that some programs do about it must be for profit. We can work with nonprofits as well. The process is more or less the same. There are a couple of hoops you have to jump through when anytime a nonprofit is borrowing money, specifically, their governance board. But no, we can work with nonprofits. We do.
Wonderful. And just to add, for the Capital Pathways program, we do also work with nonprofits.
Yeah.
So please do reach out to both of us. Next questions. What steps would you recommend for a business owner with fair credit to become eligible for grants, lines of credit, or low interest funding within the next 6 to 12 months?
One of the things about credit is there is no silver bullet. You can't make change by tomorrow, but you can start enacting change right now. So it's not an overnight process. It is habits over time. So everything we talked about, especially on the front half of this training, while we were talking about personal credit, start practicing that stuff right now. Pay on time every time, resolve any derogatory accounts. That in and of itself will start to improve your credit. Absolutely. And then if you're kind of like at a threshold and you just want to make it better, that's when you start looking and experimenting with things like availability. Okay, maybe I've got my credit behaviors are all in place. I've got my balances nice and low. I'm not overextended. Okay, well, I'm going to ask them to extend this credit card by 30% so that it increases my availability. Or maybe I get a good quality installment loan, something like that. Grants, one thing to keep in mind about grants in the small business space is The kind of joke in the community economics sphere is that everybody who walks through the door wants a grant. Of course we do, because you go, well, it doesn't have to be repaid, right? Well, there is no such thing as free capital. That's really important to remember. It all costs you something. So grants are going to cost you in outcomes. So grants, there are no just build your own wealth grants. There's no here, take this money for free and go start a business and build your wealth off of it. There's no such thing. Grants are going to be targeted at a specific outcome. So they want growth in a certain demographic. They want more women-owned businesses, or a certain sector, they want more childcare, or a certain region, we want more businesses in downtown St. Paul, Virginia, something like that. So keep that in mind about grants, as they're very targeted. Lines of credit and low interest funding, your low interest funding is going to be lower as your credit improves, because your risk is going to be rated lower. So the lower risk you are, the better rates you're going to get. And then obviously secured capital that's attached to collateral is going to be cheaper than unsecured. So an unsecured line of credit is going to be more expensive than a secured line of credit or a secured term loan. So those would be some of the things I'd keep in mind. There is no one size fits all. It's all of those as a piece. And then, pull those reports, see how it's being reported, and see how you can build on that starting today, really.
Wonderful. Next question. Since the asker's business serves vulnerable populations and shared independent living residents, are there any mission-driven lenders or funding programs that consider impact over credit score?
There are definitely mission-driven lenders that factor in impact. Maybe not over credit score, but along with can factor in. We factor in impact. The big thing to remember about impact and service is that you are not providing a service to somebody that you give a loan that they cannot repay. That's not, there's that phrase, like there's a difference between nice and kind. The kind thing to do to someone who can't repay a loan is to say no to them instead of what they want to hear. So if the business does not cash flow, nobody's going to be able to lend to it. There must be an underlying business model that is self-sufficient, that can break even, that can pay its expenses. Otherwise, you're looking at a nonprofit. And nonprofits can make surplus, but nonprofits are eligible to apply for things like grant funding. So a lot of times that's why people start them in that structure. Doesn't mean nonprofits don't make money. They absolutely do. It's just where that money goes to, goes back into operations. So that's going to depend a lot on your region. This varies very much. A lot of times organizations like this are targeted at a particular demographic, at a particular region. I couldn't speak to it, on the whole, but they are out there, but the underlying business must function.
So it looks like there's a clarification on this question.
Sure.
Um, what are mission-driven places or mission programs that are, rather than asking for free money, but some mission-driven lenders?
Question. I asked what are mission. Um, so what are some so CDFIs are mission-driven lenders. There are sometimes in localities there will be revolving loan funds. A county might say, we operate a revolving loan fund for people to start businesses in Smith County, Virginia. Those are oftentimes mission driven. But they're gonna typically be on a much smaller scale. So it's a little bit hard to speak to it unless we're talking about a very targeted region. And forgive me that I can't speak more specifically to that. But in that point I made about grants was not just about your question. That is a very, very common request, is small business grants, and they're just not that common. So that's why I take time to clarify that. That it had nothing to do with your question. So thank you for clarifying.
All righty, moving on to the next question. How would a personal pre-foreclosure from 2009 impact a person's business credit now?
Business credit, I'm not exactly sure because it does vary so widely. The biggest thing you'd want to do is pull your report and see how this is showing up. 2009 is more than 10 years ago. So if it was a bankruptcy, it'd be gone by now. A discharge bankruptcy in 2009 has fallen off of everybody's report by now. But that's really the only way to speak to it is go to annualcreditreport.com, go to each of the three bureaus and pull a report from each of them and see how that foreclosure is showing up, if at all.
Thank you. Next question is there a way to get a report for the business using the business name and EIN rather than the owner's personal information and social security number?
If it is a commercial report, it is going to be by the business name and EIN. If it's a personal report, a consumer report, it's going to be your personal information, your social security number. So that's a big key difference between the two. The biggest thing, if you want a free report, if you go to annualcreditreport.com, those are your consumer reports only. Those are the ones that you are um, entitled to by law. A business report you will have to pay for. They do not give them for free at all. So you would have to create an account, and that's entirely up to you. I'm not here and not permitted to advise you one way or the other on that. That's entirely your decision. But you would have to go to that particular commercial report bureau and then pay for that service.
Good to know. Next question. Should I open a business credit card before I get revenue if I'm primarily funding my small pottery business with personal savings?
That I don't know. Again, that's entirely your decision. You don't want to take on debt for a business that is pre-revenue, unless unless you're some like a structured company, like a tech company or something that's in a growth phase where you have investors and stuff. But that's a totally different scenario. Um, it wouldn't be bad to establish something in the business's name, but I wouldn't advise taking on debt necessarily. So if you could get one that's in the business's name, you have Justin Lewis LLC, and I open up a credit card that says Justin Lewis LLC on there. It's in my business's name. And then as long as I don't carry debt on it, that's not necessarily going to undermine my business. And then it's there and it's ready for when you are ready for investing in your business. Bootstrapping is what you're referring to, paying for it out of personal savings. That's very common. Oftentimes, to get good quality business credit, like a term loan or something like that, they are going to want to see personal equity injection. No lender, not a bank, not a CDFI, nobody else is going to want to feel like they're taking all the risk for you. So they want to see that you're more invested than they are because it's your business. And so just because you're putting your own money into it shouldn't preclude you formalizing the business, making sure you're building those business structures. You have the business bank account. If you want to establish a business credit card, again, I don't advise anybody carry a balance on a credit card because it is very expensive capital. And you don't have to carry a balance for it to count towards your credit history. Just having it open and active contributes to your credit history.
Excellent. Got a follow-on question from that same asker. They are in the pre-revenue launch phase and won't start selling for 2 years. When does it make sense to separate personal and business credit fully?
That's a great question. I'm glad you asked it. Business credit probably is not as relevant now, but separating your business and personal finances is essential. Do that ASAP. Do that from the minute you start making transactions with your business. So having a separate bank account that is dedicated to your business, whether it's an actual named business account or not, a business bank account or not, and all cash inflows go into and out of that bank account. Period. Full stop. No exceptions. Including if you make money out of it and you need to use it, you transfer it out of that to your personal account to spend. Or if you're making a contribution from your personal, your bootstrapping, you were the previous question, you transfer money into that account from your personal into the business and then spend out of that so that you have good history that you can demonstrate. So when they go to underwrite that loan, you can show this is what my business actually made. Here are the actual expenses of my business. A big, very common trap that we see with new businesses, especially if you start small, as a side hustle, and then it started to scale up, kind of like yours, a pottery business, is personal and business finances are very enmeshed, and we can't tell the difference between a personal and business expense. So it's really hard for us to validate your income. Um, you don't always have to be at profit phase to get a business loan. A lot of times the business loan is going to help you get there, but you do have to be able to demonstrate the cash flows, even if it's at break even or maybe pre-break even. So separating your business and personal finances, do it right now. As far as personal and business credit, you'll discover that probably as you go. It will start with your personal. When you go to try to get a business loan, they will assess your personal credit history. So make sure that's in order for now. Um, because they'll ask for a personal guarantee, they will, especially with a small business. So make sure that's in order right now, and then hopefully that'll set you up for 2 years when you go to try to get your business loan.
Great information. Next question. If a personal credit score is above 800, is a personal guarantee still going to be required with most lenders?
Yeah, especially with a startup business or a new business or a small business. And like I said, with SBA loans, which are they're not loans from the government, but they're funded by the Small Business Administration, they are required to give a personal guarantee. So yes, I'm not going to say 100% of the time that's not the case, but your credit score is one piece of the puzzle that basically is telling them credit performance. They're saying, hey, this Alex Churchill makes his payments on time. That's what it's signaling to them. And an 800 credit score is excellent. It doesn't get much better than that. So that is definitely in your favor, and that can probably help you get a better rate, because your risk rating will be lower. Um, but you'll probably still need to provide a personal guarantee, because think about it from their perspective. If they didn't do that, everybody who wanted to start a small business, if they wanted to get out of the debt, would just shut down the business. And they'd say, okay, all right, the $50,000 business loan I took is gone because I shuttered my business. So when you're starting, yeah, they probably will. I would expect that. But no, your credit score, the short answer, your credit score does not cancel that requirement out. Great question.
Next question. You'd mentioned about business structure. What do you mean about structuring the business properly?
I mean your formal structure. I'm going back to slide 50, like this next question is saying, so that you can look at
Mhm.
it. Uh, there you go. I'll let that sit there while I'm answering this. What I mean by that, Alex, is formally structured. So and this is not, you can have whole SBDC trainings on business structure. But what I mean by that is your formation. So are you a sole proprietorship? Are you a single member LLC? Are you a multi-member LLC? Are you an S Corp? Are you a C Corp? Those are the big things there. Most small businesses are going to start as the most common structure in the country is a single member LLC, limited liability company. I'll leave that to a legal professional or advisor to do that on another training. But that's what I mean by that is you do that with this at the state level. So you go to the SCC website. That's the State Commission Corporation, something like that, or State Corporation Commission. And you register and you say, I go on there and I say, you request, can I have Justin Lewis LLC? Because I'm doing consulting and I call it Justin Lewis Consulting LLC. I go on there and no, somebody's taken that. Okay, well, I'm going to have to do Justin T. Lewis or whatever. It's a unique name. You can also do a sole proprietorship where basically the business's identity is the same as your personal identity. That's another really common one, but you don't have that veil of liability. You are the business in that case. And then the other piece of it is, are you registered with the state, with local licensing, local permitting, depending on your town, your county, or whatever, to pay your payroll taxes and to make your federal tax payments. That's what I mean by structure. Great question.
Thank you, Justin. And I did drop the link to register for our next webinar on just that topic of structuring your business in the chat for those of you who are interested.
Organic plug. Look at that.
All right. What are some examples of trade line for businesses?
So trade line means A line of credit, or not a line of credit because that's a particular kind of product, but a trade line is when you've borrowed. So if you go onto your personal credit report, when you all go on to annualcreditreport.com and pull off all of your reports, you'll see there'll be, there's a Eastman Credit Union is the regional bank I work with down here. I will have one for the credit card I have with them and the line of credit I have with them and the home loan I have. All of it will be there. Those are each individually. That's called a trade line. So for your business, it would be a trade line would be you have this line of vendor credit that you've established and they report, or it might be that business credit card that we talked about, or it's when you got that business loan and they've reported that. So a trade line means that individual line of credit, an individual line dedicated to that piece of credit that you have.
Awesome. Next question. What do you recommend to a business who wants to purchase a vehicle using business credit, but are not sure where to begin?
That's a good question. I haven't gotten the question about vehicle purchase, so I will defer on that a bit. What I would say is I would get with an advisor who can speak more explicitly to that, like somebody who can look at your situation and help you navigate that, whether it's through the SBDC or another counseling agency, because that's a very specific question, and I wouldn't want to give you bad guidance. What that means is they're going to assess your business's creditworthiness to buy that car. So I haven't been through that process personally, and I don't plan to for my small business anytime soon. But that's a great question. Sorry, I'm not able to answer that one specifically.
No worries. And again, another organic plug, I dropped the link to our website and my email address in the chat for anybody who is interested in getting started with Capital Pathways advising. All right, next question is, what is the typical timeline to get an SBA loan approved? And are there any minimum revenue requirements?
With SBA loans, I would definitely get with an SBA lender specifically because there are lots of in and outs. There are very specific criteria and requirements for SBA loans. There are three kind of categories of SBA loans. We do SBA micro loans. Those are business loans under $50,000. But there are a couple of other categories, and they're all going to be slightly different. A lot of them require 2 years of revenues. Some of them they might have other requirements. So yes, there are sometimes minimum revenue requirements, but there is something out there for you. So, if you're looking for an SBA micro loan, we don't have a revenue requirement, for instance. And we're not the only SBA micro loan intermediary, depending on what region you're in. Timeline, for us, and we're usually dealing with microloans, but the fastest turnaround is probably about 3 weeks, and that's from the time that you get everything in. That's the big thing. Clock starts when you get everything submitted, all the cash flow projections, all of the documentation. The process cannot move forward until you get all those documents in, and that's usually the part that takes the longest. Getting a decision from there is usually a matter of a few weeks. So it's going to depend a lot on your individual lender, though. Good question.
Thank you. So when working on a business, when working on the business plan and working on use of funds, should the business owner divide it from equipment and supplies, from professional contractors, etc.? Would SBA lenders want to see estimates for all of this? And what if the business owner is factoring in obtaining a workspace?
Yeah.
Would we factor that in as well?
Yes, the more specific you can be on what's called your sources and uses. So, what's the source of funds? Where's that money coming from? And what's the use of funds? Where's it going? The more specific you can be on that, the better. The last thing you want to do is say, I need $40,000. Well, for what? Oh, well, that'll get me by, or I want to get a space. Well, how much is the space? What's the lease agreement? Or what it's gonna, this is what makes business lending hard, is that there's a lot of those things to navigate along the process. So yes, as specific as you can be about this is what the equipment costs, and then this much, 3 months worth of supplies, and then this much for my CPA or the licensing consultant that I get. That's a really common one. It costs $5,000 to get this person who licenses me for this thing. Yes, you want to break all of that out very, very specifically, including if it's getting a lease, buying a property improvements. That's another really common one. We need to upgrade this place to where it's, my office or my restaurant or my coffee shop or whatever. So, really good question. We're coming on time, so we'll slam into this last question. I'll try to get it answered.
All right, and we did get one just come in, so I think at this point we will close the questions. Thank you everybody who submitted them. If you weren't able to, please send me an email or reach out to me through our website for a session, and we'll try and get that answered.
So really quickly, everybody, if you have to go, I understand. My information is here on this slide, and Capital Pathways will send out an email as well. And if you want to include my email or my contact information, you can. But if you have any follow-up questions, feel free to shoot me an email. I'll answer what I can. And if I can't, I'll try to get you hooked up with the right person. So we are here, again, as a resource connector. So reach out if you need anything.
Thank you. All right. So when/if a person sells their business that has outstanding debt, does the liability for that business, or for that debt rather, automatically transfer to the new owner, and is the original owner completely released from responsibility?
It depends a bit on the structure of the debt. So, is it a debt? Do you have the personal guarantee on it? Was it in the business's name, or were that'll factor in. And then it'll also the terms of the sale will also. So, are they buying the debt? Um, Sometimes they are, sometimes they aren't. So, when we work with folks who are acquiring a business, one of the common questions, most kind of fundamental ones, is what are they buying? Are they buying the business assets? Are they buying the brand? Are they buying the customer book? All of that can factor in. Um, so if your business has business credit, that actually is one of the advantages of business credit once you get it established. Your business credit, the business credit is attached to the business. So, you've got this, you've been running a laundromat for 25 years and you're selling the laundromat, and all that business credit is in Londo Rama's name. That would they when that transfers ownership, the business credit goes with it. So the debt can be a little bit, that's going to depend on the terms of the deal, but the business credit will stay with the business.
Good to know. And with our final question, with getting a microloan for a startup business, what would, in your opinion, someone be able to get a microloan, even if you have to use personal credit to apply when you don't have enough business credit? I think that's
Yeah.
supposed to say, what should you do?
Yeah. So, like I said, all small businesses are going to start at personal credit. Business credit does not, start out of nothing. So it's got to start from somewhere. And so, it's always going to rely on your personal credit. So that will factor in. You can't sidestep your personal credit in order to get to business credit. It's not, the system's not really built to accommodate that. So in that case, you would work on your personal credit as much as you can. And that's the nice thing about it, since the data in, data out principle. If you work on it, it will improve. That is guaranteed. And so in that scenario where you're kind of, and a lot of folks in the small business level are kind of nudging their business up little by little as they can go, you would work on your personal credit as much as you can. You would try to get a business piece of credit that is, you still have the personal guarantee. They're assessing your personal credit worthiness in order to finance that, but it's in the business's name. So you're basically kind of co-signing for the business loan alongside your business. So it's, Justin Lewis LLC, and Justin Lewis is the personal guarantor. So that's how that would work. And then I work on that, even if it's small. I start with what I can get. So I can only qualify for a $2,500 business loan, but I get that and I use that to build my business. And then if I have good positive credit behaviors, they're going to want to keep that relationship. That's the thing about a lender. They're trying to sell you something. That's what they sell, is financial products. So if I perform well, they're going to want to retain my business. So, okay, hey, you've paid really well on this for a year. it's time for me to grow. Now I need another $5,000 to get a lease or whatever it is. They're going to be more willing to work with me, and they're going to build that relationship over time. And then all of a sudden, so it goes from there 2,500 to 5,000, and then you're into 10,000, and then 20, and then whatever. And you want to scale up in that lean fashion. You don't want to jump to the $50,000 loan until your business can handle that. So there's nothing to stop you from scaling up as you go under those lean principles. So really good questions. It can be, it can be a briar to navigate, but little by little, and I'm really happy everybody joined us today.
And with that, our time together is coming to a close. So thank you so much, Justin, for your excellent information today and for taking the time to chat with us. We absolutely look forward to future sessions with you.
Thank
And
you.
for all of our participants, a recording of today's session will be shared as part of a follow-up email that'll be sent to everybody within about a week of today. And as I said before, if you weren't able to submit your question today, please do send us an appointment request through our website or reach out to me via my email. And Justin has his information here on the screen for anybody who needs it. We will both do our best to get you connected with the resources that can help. Thank you, everyone, and hope to see you at the next webinar.